What if I told you that the biggest wealth building machine in the world doesn't make headlines? It doesn't shout. It doesn't trend. It doesn't promise overnight riches. It works quietly, year after year, compounding in the background. And the engine behind it is something called return on invested capital, ROIC. Now, don't let the term scare you. It sounds technical, but the idea is beautifully simple. Every business needs money to operate. It invests in equipment, technology, employees, marketing, inventory, buildings, all the tools required to generate profit. That pool of money is called invested capital. Now, here's the real question. For every dollar a company puts into the business, how many dollars does it get back? If it invests $100 and generates $20 in profit, that's a 20% return on invested capital. If it invests $100 and earns only $5, that's 5%. That's it. ROIC tells you how efficiently a company turns investment into profit. And that efficiency changes everything. Imagine you have two machines. Machine A takes in $1 and spits out $1.25 every year. Machine B takes in $1 and spits out $1.05. Which machine would you want to own? Which one would you want running for the next 20 years? The difference may look small in a single year, but over time, that gap becomes enormous. Because when a company earns high returns and reinvests those profits, it compounds. And compounding is one of the most powerful forces in finance. You've probably heard about compound interest in a savings account. But inside a business, compounding can be even more powerful because the returns can be much higher. If a company consistently earns 20% on its capital and keeps reinvesting, its growth doesn't move in a straight line. It accelerates. Profits generate more profits, and those profits generate even more. That's how small businesses turn into giants. But here's something most people misunderstand. Growth alone doesn't create value. Read that again. Growth by itself means nothing. If a company grows revenue quickly but earns poor returns on its capital, it may actually be destroying value while looking impressive on the surface. Let me give you an example. Suppose a company opens new stores every year. Sales rise rapidly. Headlines celebrate expansion. Investors get excited. But if each new store requires huge investment and only produces small profits, the company is tying up more and more money for mediocre returns. It's running harder, but not getting much richer. Now compare that with companies like Apple or Microsoft. These companies have historically generated very high returns on invested capital. They don't need massive physical infrastructure for every dollar of profit. Their products, software, devices, ecosystems, allow them to earn far more than they spend. That difference compounds. And over decades, it creates extraordinary wealth. But there's another piece to this puzzle that's just as important: capital allocation. ROIC tells you how good a company is at generating returns. Capital allocation tells you how smart it is with those returns. Once a company earns profits, management must decide what to do with that money. Should they reinvest in the core business? Should they launch new products? Should they acquire another company? Should they pay dividends? Should they buy back shares? Or should they sit on cash? Every decision affects long-term value. Think of the CEO as the chief investor of the company's profits. Every year, they're handed a pile of cash, and they must choose where to deploy it. If they invest in projects that earn high returns, value multiplies. If they overpay for acquisitions or chase trends that don't produce strong returns, value quietly erodes. Here's a powerful question. If you owned 100% of a business, would you want its profits reinvested at 25% returns or handed back to you to invest elsewhere at 8%? That's the capital allocation decision in simple terms. High ROIC companies have a huge advantage here. because they can reinvest internally at attractive rates. They don't need to rely heavily on debt. They don't need to constantly raise new capital. They can fund growth from their own profits. And that creates independence. Independence creates resilience. Resilience creates longevity. Now let's zoom out and think long-term. Imagine two companies. Company A earns 30% returns on capital but grows moderately. Company B grows very fast but earns only 6% returns on capital. At first, Company B looks more exciting. Faster growth, bigger headlines, bigger expansion. But over 15 or 20 years, Company A often wins. Why? Because high returns on capital give it fuel. Even moderate growth compounds dramatically when returns are strong. Meanwhile, Company B constantly needs more capital just to maintain its pace. One builds wealth internally. The other constantly consumes resources. This is why serious long-term investors pay close attention to ROIC. Not just 1 year, but consistently over many years. Consistency is key. Any company can have one great year, but sustaining high returns through competition, economic cycles, and technological change, that's rare. And rarity creates value. Let me ask you something deeper. Why are some companies able to earn high ROIC for decades? Usually because they have some kind of advantage. It could be a powerful brand, it could be network effects, it could be intellectual property, it could be switching costs that make customers stay. It could be cost advantages competitors can't match. These advantages form what investors call a moat, and that moat protects returns. Without protection, high returns attract competition, and competition drives returns down. So when you find a company that maintains high ROIC for years, you're often looking at a business with a strong competitive position. Now think about how this plays out in tough times. During recessions, low-return businesses struggle. They may have heavy debt. They may require constant reinvestment just to survive. Margins shrink quickly. High ROIC companies, on the other hand, usually have stronger balance sheets and better flexibility. Because they generate more profit per dollar invested, they have room to maneuver. They can cut back temporarily. They can invest while others retreat. They can even acquire weaker competitors at attractive prices, and that widens the gap. Over decades, this gap becomes massive. Stock prices, in the short term, move based on emotions, fear, excitement, hype. But in the long term, stock prices tend to follow business economics. And business economics are driven by returns on capital. If a company consistently earns returns above its cost of capital, meaning higher than what investors could earn elsewhere at similar risk, it creates true economic value. If it earns below that threshold, even growing profits can destroy shareholder wealth. This is why understanding ROIC changes how you see businesses. Instead of chasing trends, you start asking better questions. Is this company efficient? Does it need constant capital to grow? Are its returns durable? Is management allocating capital intelligently? Those questions cut through noise. They focus on fundamentals, and fundamentals compound. Now imagine this effect over 30 years. A company earning 20% returns and reinvesting wisely can multiply its capital many times over. Even if growth slows, the sheer efficiency drives value. It's like planting a seed that grows into a tree, that drops seeds, that grow into a forest. Meanwhile, a low ROIC business is like planting seeds in rocky soil. You need constant effort, fertilizer, and reinvestment just to keep it alive. Which would you rather own? Which would you rather trust with your money for decades? High ROIC companies aren't always the most glamorous. They're not always in the hottest industry. Sometimes they operate in boring sectors, but they execute with discipline. They understand something powerful. Every dollar of capital is precious. When management treats capital like it's their own money, not just numbers on a spreadsheet, long-term value tends to follow. And here's the emotional truth behind all of this. Wealth is rarely built through excitement. It's built through discipline, through patience, through allowing compounding to work without interruption. High ROIC companies give you that opportunity. They are the hidden compounding machines. They quietly turn invested dollars into more dollars year after year. They don't need constant applause. They don't need constant funding. They simply execute. So the next time you evaluate a company, don't just ask how fast it's growing. Ask how well it uses what it already has. Because in the end, businesses are not measured by how big they look. They're measured by how effectively they convert capital into profit and how wisely they reinvest it. And if you can find companies that do both consistently, earn high returns, and allocate capital intelligently, you may have found something rare, not a trend, not a gamble, but a compounding machine. Quiet, relentless, powerful, and over time, unstoppable. Thanks for watching. Don't forget to like and subscribe to our YouTube channel